Welcome back. You're tuned into Bazaar Morning Call. As promised, Dipan Mehta, Director, Elixir Equities, joins us on the show. Hi, Dipan. Good morning. Good to see you in. Dipan, I had a busy, holiday yesterday, actually, because had to go through this deal with regard to Ultratech. All of a sudden saying that cables and wires is the space we want to be in. What's your initial reaction to this? There could be a knee-jerk negative reaction on Ultratech Cement because, it's not in their core cement business. And also, do you think cables and wires players will feel the heat? Though you need to keep in mind that paints companies were trading at 60 multiples. These cables and wire business are at around 30 multiples. So in that case, that could be some cushion. Your take.
Yeah, good morning, Nigel, and thank you for having me on your show. I think that it's not a very big, serious diversification for Ultratech. We need to understand their reasons for getting into this particular business. See, when they went into paints, they went, completely inside, setting up several plants and making massive investment, that too through Grasim. But in this case, it's a small 1,800 crore capex plan. As I heard from you, it's just 10% of their overall capital expenditure plan. And it's not going to be such a big venture for them. And we need to understand what exactly the thinking behind the cables and wires entry for this particular company. But I don't think it's going to impact any of the existing players. I think they are very strong brands, a distribution network, relationships. A lot of them are very good exporters as well. So it'll take time for it'll take time for Ultratech to catch up, if at all.
Okay, all right. So you're saying that if there is weakness in some of these cables and wires business, it'll be a good entry opportunity. Is that what you're trying to tell us, Dipan?
See, I still feel that these cable companies are trading at very rich multiples, considering it is a type of a cyclical business and there's volatility in earnings. Raw material costs do impact their operating profit margins. But sure, I mean, if there's a correction, one could look at these companies if you are fundamentally very comfortable with the valuations. But by and large, our preference is for consumer-oriented businesses or consumer appliance companies. And within that, I think Havells particularly comes to mind, which has got a cables business, but as a solid air conditioning as well as other home appliances business. And if that valuation comes at reasonable levels, I think it could be more appropriate than some of the other pure play cable companies.
So Havells, but just one more question. Would you have preferred that they have actually done it through Grasim rather than Ultratech?
Yeah, I would agree. So, I mean, because Ultratech is a cement company, India's largest cement company. And sometimes when you want an exposure to a pure play cement company, you would go to Ultratech. But now you have this cables division also within Ultratech. But as I said, it's just going to be a very small division. And over time, the management will explain the logic of getting into this particular business.
But one thing is clear, right? Yeah. All industries are seeing, it's not disruption, but newer players, hospitals, all these conglomerates coming in. Paints, Ultratech first, and now JSW, and now, of course, the cables and wires.
The biggest beneficiary could be consumers, and because ultimately earlier there was this unwritten rule that I will not get into your space, you will not get into mine. Yeah. But now that's clearly broken over the last few years, and that could bring pricing down, which will ultimately be good. So,
interesting. I don't know if you have the number. What percentage of the cables and wires segment is unorganized?
That's 30%. So 30%? The total industry is 80,000 crores. Approximately 30% is unorganized. So that could 26 to 30% roughly.
Yeah. So the point is that sometimes we think that a large company enters the space and it's bad for existing players. Yeah. But if a large segment is unorganized,
then it could.
It doesn't necessarily need to hurt.
Yeah.
Many of these cable and wire companies, when we speak with them, have guided for what 15-20% kind of growth rates, right?
Yes.
So it's not necessary that the entrant is taking market share away, although it will in some degrees. The margin incrementally is negative, but it's not necessarily in that sense hugely negative over a period of time. Today, of course, stocks are another matter. Dipan, banks and financials with the RBI cutting risk weights. There is, of course, a significant shift, as we are seeing. I first started sort of mentioning this when we started to see the rupee depreciate, so on the forex management side, and now we are starting to see some actual measures as well. Your thoughts?
Yeah, I think that, Prashant, after several quarters, maybe years of underperformance, you may see banks having a cyclical upswing and improvement in their earnings. Base effect also will benefit them because provisions have been increasing for these companies over the last 4 or 5 quarters or so, and now perhaps they will flatten out and core pre-provisioning operating profits also may start to look up. So you would see, I would say, year-on-year growth in bottom line. and a cyclical upswing in stock prices. But 3-5 year period, our view on banks is slightly cautious. It's becoming a bit of like a red ocean, and there's going to be pressure on net interest margins. The minute these banks start to lend into high yield products like personal loans or microfinance, their NPAs are going up after a few quarters or so. So some additional risk factors are coming in. So while we're heavily invested in banks, 25-30% of our portfolio, and we would remain invested for the next 4-5 quarters or so. But over the longer period of time, one need to have a proper kind of a strategy to be underweight in banks.
You heard that conversation from Sirma. I mean, a stock-specific takeaway of the EMS space.
Prashant, I was just checking while you were interviewing the management. The stock is off 40% from its peak, and it's a blue chip company in a very high growth space. I think valuations have also come off. If you analyze their fourth quarter earnings, then it is trading at a P multiple about 38 times or so. And management seems pretty positive that they can sustain that 25% type of top line growth. It does appear to be so based on the order book as well. So I would say that this is a good time to get into EMS companies like Sirmia. There are anyway very few pockets where there is sustainable secular growth, and EMS is one of them. So considering the kind of position of the management and the risk return profile, definitely I think Sirmia SGS looks like a good buy at this point of time.
Thanks for staying on. Now, I just want a quick word on Religare, right? We had last week, we had that big, I think it was a massive move, some 15-16%. I think it was last Friday, I think. And then from there, it's corrected quite a bit, back to about 236. So high that day was a very sharp move. Yeah, it was that Friday. 267 was the high. We're back at about 236. Any thoughts here?
See, Prashant, at least one uncertainty is out of the way now that they have a new promoter in place, and the Abba Group has got deep pockets. And this is a business which requires capital from time to time, which they can certainly subscribe or arrange for the company. But gradually, I think the overall business momentum as far as wealth managers, mutual fund distributors, insurance companies, all the capital market players, I think they've had 2-3 very good solid years, and you could expect a cyclical softness within that sector. So from that point of view, I want to be a bit cautious on the entire industry, and I have actually not studied Religare that closely and what are going to be the actually moving parts which will take the revenues and profitability higher. So I would just say wait and watch. Let's see how the business evolves, and then perhaps you can take a call on Religare.
Okay, all right. Dipan, I wanted your view on the two new entrants into the Nifty in the next 1 month or so, Zomato and Jio Financial. Now, both of them, from the peaks, they've seen a good correction. Now, there could be some kind of allocation because obviously when you're adjusting yourself and coming into the Nifty, what's your view? Zomato has come off considerably, as is the case with Jio Financial, which bulk of its SOTP comes in because of its holding in Reliance. Your take?
Yeah, Nigel, I'm a bit surprised with the inclusion of these two companies, but nonetheless, I think Zomato, our view is very positive. We have a long-term view on the long-term positive view on Zomato, and it's kind of part of our core holdings as a measure of disclosure. We want to own it for next several years or so, and do feel that it can give great returns. Can't they say the same for Jio Finance? A bit disappointed with the kind of growth which has come through since listing. And look, again, it's a very competitive space. And I would say in terms of valuation, there are better plays within the NBFC, like say Bajaj Finance or the Cholamandalam. And I'm not sure that Jio Finance will be able to scale up as well as a lot of people on the street are expecting.
Dipan, I don't know if you tracked this one. We don't actually talk about it at all, but there's a stock called E2E Networks. L&T had bought stake, if you remember, right, in two tranches. One tranche was around 3,700. The other one was about, I think, less than that. The weighted price we'll have to see. It's under 2,000 rupees now. Any thoughts here if you've looked at this?
Yeah, Prashant, we have had a look at it, and it's a great business, and they seem to be in the right place at the right time. Fantastic momentum when it comes to revenues, but look at the valuation. I think you need the stock price to half from these levels to justify buying into E2E. Yeah, I know. When you look at the price, also look at the PE multiple. I think it's trading at 70-80 times. I'm not pretty sure. You can pull that up. So at these valuations, I think a lot of the positives are captured. But keep these stocks under the radar. If a quarterly number comes which is surprisingly very positive, or the stock corrects significantly from these levels, and you get it in that sweet spot where the PEG, price earnings to growth, is about 2 times or 1.5 times or so, then that's a good entry point. But definitely a company worth watching. They seem to have a very different type of a business model. And as I said, I think growth momentum is very strong.
You know, in the jewelry space, Dipan, right, after the sharp sell-off in Kalyan, there was some view emerging that, well, better to be with the one big name, Titan. On Friday, but last day, Tuesday, Tangamail was up 20%, circuit up. I don't know if you've got a view here.
See, I think what we are seeing is that after a long time, a lot of the tier 2 jewelry companies, be it Kalyan, Tangamail, and some of the other new listings, their growth profile is very much similar to Titan, slightly better as well. And they seem to have got a lot of their issues sorted in terms of distribution, growth, branding, so on and so forth. And now with the budget offering that no income tax up to 12 lakhs, definitely consumption is going to get a boost, especially discretionary consumption, and jewelry is one of it. So I'm very positive on the space per se, and definitely willing to look at some of the tier 2 players, including Kanjan and Tangamail and some of Senco Gold, and there are so many other new, at least 7 or 8 new listings which are there. And these companies, I think, are at far more reasonable valuations than Titan, where growth rates, frankly, have been disappointing for the past 2-3 quarters. So you could look at a shift out of Titan, some of the tier 2 jewelry companies, and that could be a good strategy for short to medium term as well.
Dipan, thank you very much for that. Let's